Are you trying to sell your home and you're finding that it's on the market longer than you expected and not as many offers? Or are you trying to buy a home and you're hesitant because of the increase in interest rates? We have a solution for you today. We're going to talk about 2-1 buydowns. Let's start with what exactly is a 2-1 buydown?
So a 2-1 buydown is where you're temporarily buying down the interest rate. It's right now what you're hearing, it's a buzzword in the market, 2-1 buydown. It means if the market rates are 7.5%, which is right around where they're at right now, it's buying it down to 5.5% the first year, 6.5% for the second year, and then it levels off at 7.5% for the remaining 28 years of the mortgage.
Right.
So on these 2-1 buydowns, the thing to remember is that the interest rate, the start rate, is the rate we're going to qualify you on. Even though the first year is going to be 5.5% and the second year will be 6.5%, you're going to go back to that 7%. So you have to qualify for that
At the
amount.
7.5%.
You have to qualify whatever that note start rate is in order to make the loan work. So even though we're going to lower it down so you have maybe a little less payment the first year, second year, say you're starting a new job or something, and you know that your salary is going to increase over the next 2 years, it might be a good option for you.
Yeah. So there is a cost for doing these 2-1 buydowns, and the cost cannot be paid by the buyer. It has to be either paid by the seller or the lender. So it's not like a percentage. It's not, let's say if it's $100,000, it's 3%, so it's $3,000 for the cost of it. It's calculated based on loan amount. So I think the best thing anyone can do is reach out to the lender, when writing an offer or trying to decide if you're going to qualify for this program, and find out what the cost is, because it's an actual seller concession. And what I found interesting is this fee that's collected up front. This is a way for the servicer of the loan to pay the owner of the loan, the investor, that shortage in interest those first 2 years. So you're going to secure a loan at 7.5%, but that first year is going to be 5.5%. So that difference between 5.5% and 7.5%, that interest, this fee is what they use to pay the servicer back.
Yeah, they call it a subsidy.
I thought that was really, really interesting. So I think it's important because all the lenders, don't you guys know, see all the lenders out there are advertising this?
It's a buzz right now. Everyone's talking about 2-1 buydowns because people are freaked out about what has happened to the interest rates this year.
Or they still want to buy and they don't want to rent because rent's exaggerated. So there are pros and cons. So we're going to give the actual facts of this. We're not just going to sell a product that's not going to meet everyone's needs. It may not be good for some people. So
Yeah, it may not work out, especially if you can buy down your rate yourself and put it in a lower, pay the points, buy the rate down, and not have to worry about the seller paying those fees for you, because not a lot of sellers are going to do that. But then sellers have been sitting there with their house on the market. They may want to.
It's a good way for them to get their house looked at.
Right.
Offering a 5.5% interest rate on this house. They're paying for the difference, so it's attracting buyers.
right.
Yeah.
I think what buyers need to keep in mind though is they are going to have a significant payment shock.
Yeah.
After the third
first
year.
and second year. Not only is the interest rate going to go from 5.5% to 6.5% per se, and then 6.5% to 7%. So that's 1% payment shock, and they can't lose sight that they're also going to have escrow analysis done.
Real
during that
estate
time frame.
taxes are going
So
up.
if taxes and insurance go up, which they do,
They
go
do.
up when you become owner of record and the property's reassessed. Insurance is going up on an annual basis. Don't even get me started on insurance, please, because I will have a meltdown. So payment shock is a big deal. I think this program is probably better for someone that expects an increase in.
In their
Yes.
income.
Right.
Yeah.
Yeah. An
They just
increase within 2
graduated,
years. Graduated, got their degree in what they want to go into, and they know their income's going to go up substantially 2 years down the road.
Right.
This is a great product for them.
Or they're
It
starting with a
eases them
base and they
into-
don't have 2 years commission to calculate. Or their spouse just started their own business and you need 2 years tax returns to, have the spouse's income. So there are times where people know and project their income situation will go up. But if you're not certain of that, it may
You
not.
still have to qualify for that.
Yeah.
That's what
Start
we're
rate.
here for. One of the cons that we were talking about is if a buyer is going to be in the house for long term, let's say 10 years or more, does it make sense to go with the temporary buy down? Probably not.
No.
If they're only going to be in their house a couple of years because they know they're going to be relocated by their employer or something short term and they would rather buy than rent, this is a good program for them.
Right. And also builders too. So, seller concessions. I think seller concessions, personally, seller concessions, I would rather have someone buy down the rate permanently than the 2-1 buy down.
Yeah.
Or for a builder, instead of doing this 2-1 buy down, to me, that builder concession to go towards closing cost or go towards granite countertops or, enhancements to
In
the
the
house.
long run, makes
In
more
the long
sense.
run, that makes more sense.
Especially if they're gonna stay there for a while. And interest
Right.
rates are gonna probably go back down, so
Yeah.
eventually they're gonna refinance out.
Yeah, I'm telling people, in the next 6 or 12 months, we're gonna refinance them, so.
You're
it's-
married to the house. You're not married to the mortgage.
Yeah, you date the rate.
Yeah, you take the rate,
Marry
you
the
marry the
house.
house.
Date the rate.
Right. So just be cautious because a lot of people are just throwing this out there, like you said, a buzzword. This 2-1 buy down is going to be the answer to everything. Maybe it is. Maybe it's not. If you have any questions about this podcast or have ideas for future podcasts, please email us at mortgagechicks@vandykemortgage.com.
Please follow us on Facebook at Mortgage Chicks with Hot Tips.
You can also find us on our YouTube channel, Mortgage Chicks with Hot Tips.